Well, the market finally had a down day, but the main point here we're going to talk about is the fact that big banks are warning for major recessions here, severe recessions, and yet we look and actually a month out, 1 month, the Dow Jones has gone up 16%. Year to date, the Dow Jones is officially only down 18.5%. But we're calling for major recessions. You see here, JP Morgan warns of a fairly severe recession, saying that profits will nosedive at companies, and absolutely you've seen it so far. So we're going to go ahead and take a look at bank earnings and see how that really reflects as far as what we see is coming for the economy. So I think this is going to be huge. Obviously, we need to know what is going on in this market. It's hard to say. I think it's fair to say this market is in a little bit of a short squeeze. And I mentioned before, I do see downward movement coming here around 10-15%, probably more downward movement. And that's more in the short term, so we're talking within the next 2 weeks, I would assume. Investors kind of sell out their positions that they bought into, but we'll take a look at that and see how we can tell that that's probably going to be the case. For one, obviously, you see awful economic numbers in terms of employment, or unemployment, that should be. Really rough stuff there. A lot of people losing their jobs. Everything's shut down right now still, so as far as the severe recession is concerned, I think there's a good chance we could see recovery. So in the short term, this is going to be hit. But we see that actually about half of CFOs expect a V-shaped recovery or to return to normal economic status in Q3 of this year. Survey of 333 senior financial executives. About half of them say that we're going to return to completely normal. 40%, around 40% of CFOs expect a longer period into 2021 or a U-shaped recovery. So they don't think until 2021 we'll actually get that recovery. And there's 9% that believe 2022 will be the first time we get to see it. And it depends, obviously, on the companies. Some of them might not see normalized revenue until 2022. Some of them might. You think about it like a company like a cruise line, which people might not necessarily return to those right away. Obviously, this year, people will still be a little bit afraid of anything like that. So they might not necessarily have the same demand until maybe a year or two out. So that's understandable. But around 50% expect a V-shaped recovery, meaning, as you look at the Dow here, they're talking about revenue mostly, but if you look at the Dow, V-shaped would mean we're talking about like what we see right here. This here is a V. On the right-hand side, you see a V. They're expecting a V-shaped recovery, meaning this is going to keep going up. Now, I think there's going to be more of a W type. I think we're going to have another downward movement, then go right back up. But I think I do agree, and I'm on the side of Q3 being a lot more normalized. I don't think it goes without saying there's going to be a lot of economic impact that extends beyond this quarantine, no doubt. But I think there are good things coming. I think we're going to maintain social distance policies, but I do think economic reopening, I think it's going to be a certainly potential thing mid-May, maybe even early May. We have a team right now working on deciding when to do it, but as such an economic powerhouse, we're going to want to open up the economy sooner rather than later. This crisis is not nearly what we were projected to have, thankfully. And obviously it's because we shut down. But what's major here is the fact that we're going to have antibody tests which can tell us who is immune to this or who may have had it already that can't get it again. And once we get that, really it's an easy process to start running certain segments of the company or the economy back up. They're not going to bring up everything just in a snap, right? If they start things in May, it's not just going to be everything's back up and running. They're going to normalize it slowly but surely, and somewhere by like July, we might see everything up and running. But I would say May, early May, mid-May, we're going to see an opening of certain things, extra things, and then probably by like July, you might start to see openings of mass gatherings again. I do think it's something that's 100% on the table. And I agree. By Q3, I think a lot of companies are going to see a V-shaped recovery. They're going to see a lot more demand back in their stores. It's going to be like normal. So The concern obviously is going to be with the short term. Think about it. Look at a company like Bank of America, down 7% today. Bank of America went ahead, put up a GAAP EPS of 40 cents, only missed by 14 cents. Not bad, all things considered. They beat on a revenue perspective, but the thing we like to look at here is a huge reserve build. So they missed the 60 cents consensus as the bank takes a $3.6 billion reserve build due to deteriorating economic outlook. So they're saving up $3.6 billion in cash for the purposes of liquidity and in case they need it for any sort of investment, stuff like that. So they're waiting and putting money on the sideline, waiting. Right? And the thing is, it's not just them. It's Wells Fargo. Wells Fargo put up a GAAP EPS of 1 cent, missed by 52 cents. Revenue down $1.5 billion from consensus. And Wells Fargo, you see, is securing $3.1 billion in reserves. They're storing cash like no freaking other. I think it goes without saying. You see, obviously, that the business themselves, they're doing fine, but they're building all this cash position up. So in case we get into worse economic situations, they're prepared and they have the money and liquidity for it. J.P. Morgan missed by $1.34. Holy crap. Missed revenue by $1.2 billion. So they're preparing with a reserve of $6.8 billion. Holy crap. That is what I think is crazy. They have a total reserve of $8.3 billion versus last year $1.5 billion only. So they're saving up quite a bit. In 2009, the financial crisis, they had $8.6 billion on the sidelines. Right now, they've got 8.3. So they're expecting that type of recession. So that is what I would say is very crazy. I don't know. That's wild stuff. They're becoming highly liquid. Company remains well capitalized and highly liquid. Good grief. A lot of money with this company. They're storing a lot. Good grief. And Goldman Sachs, Goldman Eat My Sachs isn't even done with it. Missed by 18 cents. Not all that bad. All things considered. Beat by $820 million in revenue. Honestly, all things considered, that's not too bad. But again, they're building a reserve. Estimate of they missed the estimate there. Reserve build. Let's see. Where the heck? They're hiding my reserve build. They're hiding it. They're definitely hiding it. Let's see. Well, obviously they don't want to hide it, but their liquid assets average $243 billion versus an average of $237 billion in Q4 last year. So they're growing in terms of what they have for liquid assets. They're increasing liquidity just significantly. They keep building that cash pile. And I think that brings a lot of concern because people think there's going to be, and I don't think there's any doubt, Q2 is going to be horrible for companies, right? There's a lot of companies that are going to be reporting earnings next week. And then from there, we even are going to see next quarter is going to be pretty rough. Probably at least half of their quarter is going to be completely ruined by this. Potentially some companies, the entire quarter. But quarter 3, I think, is where we're going to see that turnaround and normalization. I think we're going to get to a more normal type of life, as much as we can get normal. People are pretty resilient, and they can forget about things pretty quickly. This was not nearly the nightmare we thought it could have been, and what we projected originally. And I think that's why people will try to forget about it. They're going to try to live their normal lives, and people want that already. People are tired of staying inside already. They want out. So I think that V-shaped recovery is a potential. But right now, this market is in such a short squeeze. I'm just going to put in my normal $100 a week, right? Right now it's $150 a week, I guess. I'm going to put in my normal, what I put in a week, into my accounts. That's what I'm going to do. Nothing extra, nothing less. Because that's the thing. I'm all about consistency, so I want to have a set schedule. My budget's set out for this, and I have plenty of money in reserve in case we go down again. If we do go down again, I'm going to up how much I'm putting in for the time being. I wish I had put in more, obviously, when we dipped pretty far down, and I don't think we're going to reach those levels again this year at all. So I think at worst the Dow goes down to maybe a 21,000, 20,000 range. That's probably the lowest it'll go again. But if it did, I'm taking it. One thing to realize, though, is that's not every company is going to do this. There's select companies that are winners. We see some companies that are sucky. Clothing down 51% in March. No shocker. No, they were all closed. No one wanted to buy clothing. It's like a spreader of germs. Food services down 23. Furniture down 25. Electronics appliances down 25. 24% downturn in department stores. Grocery stores, though, saw a 29% jump in sales. Home improvement stores found a 7.6% increase. And I talked about this before. The more people are stuck at home, the more they find imperfections in their house. And companies like Lowe's and Home Depot, I called this before, these analysts, they can eat it. I'm smarter than they are. That's just how it is. Sorry. They have no clue what they're talking about. I knew this is not a surprise. I don't know. It doesn't surprise me. That's all I'm saying. I called it out from the start. That's all I'm saying. Non-store category, Amazon was up 9.7%, but not nearly as much as what you saw with grocery stores. So the demand was pretty massive. I like it. I like everything going on. There are going to be certain companies that just outperform the market. It's just how it is. So I'd say maintain a buy and hold strategy. Be consistent. If the market goes down, put more money in. But there are companies that are going to do well regardless of this. And regardless, if you're picking a good company, whatever the price is now, you should feel confident 5 years down the road. You'll be very happy with that investment decision. If you're not feeling that way, don't buy the stock. Really just do it on a stock-by-stock basis, not the whole market. It doesn't necessarily be trading the whole market. Do it on a stock-by-stock basis. But that's really all I have for you today. Hope you enjoyed.